The financial crisis of 2008 was significant. According to Ben Bernanke, it may have caused a catastrophic worldwide financial and economic crisis akin to the one that occurred in the 1930s. But what took place? Why did it take place? We must first quickly clarify what mortgages are before we can describe what happened. You may already be aware of the fact that, in general, a person who wants to purchase a property would frequently borrow hundreds of thousands of dollars from a bank. The bank receives a mortgage as payment in exchange. The homeowner is required to repay a portion of the principal, plus interest, to whoever is in possession of the document each month. A default occurs if they cease making payments. And the house belongs to whoever has that piece of paper. The bank, the initial lender, frequently sells that mortgage to a third party. Historically, it was rather challenging to obtain a mortgage if you had poor credit or an intermittent work. The chance that you would default on your loan was just too great for lenders to handle, but things started to change in the 2000s. In the 2000s, foreign and domestic investors began pouring money into the U.S. housing market in search of a low-risk, high-return investment. The idea was that they could earn more money from mortgage interest rates than they could from investing in items like treasury bonds, which were paying extremely low interest. Global investors and huge money, however, were unwilling to just purchase my mortgages. Instead, they invested in securities known as mortgage-backed securities. Securitization of mortgages by major financial institutions results in the creation of mortgage-backed securities. In essence, they gather thousands of individual mortgages, bundle them, and offer investors shares of that pool. These mortgage-backed securities were a huge hit with investors. Once more, they provided a better rate of return than investors could get elsewhere, and they appeared to be extremely safe investments. One was that house prices were steadily rising. In the worst-case scenario, lenders thought, we can just sell the property for a higher price if the borrower fails on the mortgage. In the meantime, investors were being told by credit rating agencies that these mortgage-backed securities were secure investments. Many of these mortgage-backed securities received AAA ratings, the highest possible rating. Mortgage debt was a wise investment in the past, when mortgages were exclusively available to people with strong credit. Investors were compelled to purchase ever-increasing quantities of these securities. Lenders therefore tried to support in the production of more of them. But they need more mortgages to produce more of them. As a result, lenders relaxed their requirements and gave loans to applicants with bad credit and little income. These are referred to as subprime mortgages. Eventually, some institutions even began generating mortgages using so-called predatory closing techniques. They provided ridiculous, adjustable-rate mortgages with payments that customers could initially manage but subsequently grew beyond their means. However, these brand-new subprime lending techniques were new. Therefore, credit reporting organizations could still use past data showing that mortgage debt was a secure investment. It wasn't, though. These investments were getting more riskier over time. However, investors continued to spend heavily because they believed the ratings. Additionally, traders began offering a riskier instrument known as CDOs, or collateralized debt obligations. Again, despite the fact that many of these investments were composed of these highly dangerous loans, some of them had the highest credit ratings from the rating agencies. While bankers, dealers, and investors poured money into the American housing market, home prices throughout the country continued to rise. Housing prices increased as a result of the new loose lending standards and low interest rates, which only served to increase investors' perceptions of the value of mortgage-backed securities and CDOs. The bank would still own this incredibly valuable property if the borrowers failed, right? Not necessarily. Rapid growth brought on by irrational choices. This was a bubble, and bubbles have a propensity to pop. And so did this one. People just were unable to afford their extortionately expensive homes or keep up with their rapidly increasing mortgage payments. As borrowers started to fail, more homes were once again available for purchase. However, there were no buyers. Home prices began to decline as a result of the increased supply and decreased demand. Some borrowers found themselves with mortgages that were far more than the value of their homes when values dropped. Some stopped paying. More defaults followed, which further lowered prices. At the same time, major financial institutions ceased investing in subprime mortgages, leaving subprime lenders with a backlog of troubled loans. Some very significant lenders had filed for bankruptcy by 2007. The issues eventually reached the large investors who had invested heavily in these CDOs and mortgage-backed securities. And their investments began to lose money. Financial institutions also had unregulated, over-the-counter derivatives, such as something known as credit default swaps, which were essentially offered as insurance against mortgage-backed securities, on their books, which exacerbated all of these issues. Does AIG sound familiar? These insurance plans cost tens of millions of dollars to sell, yet there was no money to back them up in case something went wrong. And as we just said, a lot of bad things happened. These credit default swaps were also converted into other securities, allowing traders to basically place very large bets on whether the value of mortgage securities would increase or decrease. The consequence of all these bets and financial instruments was a very intricate network of assets, obligations, and hazards. So the entire financial system suffered when things went wrong. Some significant financial players, including Lehman Brothers, filed for bankruptcy. Others had to rely on government bailouts or mergers that were forced upon them. Due to the complexity and lack of regulation around some of these financial institutions' assets, it was difficult to figure out just how poor their balance sheets actually were. Fear took hold. The credit markets and trading both stopped. Stock prices plummeted. And the US economy unexpectedly fell into a terrible recession. So what did the government do? The Federal Reserve intervened and provided banks with emergency loans. The goal was to stop banks that were fundamentally sound from failing because their lenders were scared. The Troubled Assets Relief Program, TARP, which the rest of us refer to as the bank bailout, was implemented by the government. This originally had $700 billion set aside to support the banks. It ultimately cost $250 billion to bail out the banks, and additional assistance for automakers, AIG, and homeowners was added. This, along with loans by the Fed, assisted in halting the spread of panic across the financial system. The biggest Wall Street banks were subjected to stress tests by the Treasury. Bank balance sheets were scrutinized by government accountants, who publicly declared which ones were reliable and which ones need further funding. Some of the ambiguities that had prevented institutions from lending were eliminated as a result. In January 2009, Congress also approved a sizable stimulus program. Through more expenditure and tax cuts, the economy received an injection of more than $800 billion. This made a dent in the spending, output, and employment free fall. The Dodd-Frank Bill, a financial reform, was adopted by Congress in 2010. To promote transparency and stop banks from taking on too much risk, actions were taken. To stop unscrupulous loans, a consumer protection agency was established. Financial derivatives have to be exchanged on exchanges that everyone on the market could see. Additionally, it established the framework for huge banks to fail in a managed, predictable manner. However, there is disagreement about whether this regulation is sufficient to avert further catastrophes. What does this teach us? Perverse incentives were, in fact, a major contributor to the financial crisis of 2008. When a policy has an unintended negative outcome, it is said to have a perverse incentive. For instance, mortgage brokers received bonuses for making larger loans. Nevertheless, this drove them to create riskier loans, which ultimately reduced earnings. Moral hazard results from this. This is when one individual takes on more risk since the risk is being borne by someone else. Because they intended to resell the mortgages, banks and other lenders were eager to lend to subprime customers. Everyone believed they could transmit the danger to the next person in line. Naturally, when something bad occurs, people search for someone to blame. No one had to go very far to find the root of the 2008 financial crisis, since the pain and blame were felt throughout the entire US economy. The government failed to regulate and supervise the financial system. Some of the blame is due to the years of deregulation in the financial industry. Regulators themselves are to blame for not doing more. The financial industry failed. Everyone in the system, from the major financial institutions to ordinary borrowers, were taking on too much debt and risk. To invest in riskier assets, the institutions were taking on enormous debt loads. Additionally, a large fraction of homeowners took out mortgages they couldn't pay. But the thing to remember about this massive systemic failure is that it happened in a system made up of humans, with human failing. Some didn't understand what was happening. Some willfully ignored the problems. And some were simply unethical, motivated by the massive amounts of money involved. But it's important to keep in mind that this severe systemic failure occurred because of human error in a system made up of people. Some people weren't sure what was going on. Some willfully choose to disregard the issues. Others were just immoral, driven by the enormous sums of money at stake. Thank you for watching our video. We hope you found the information we presented to be insightful and informative. If you have any further questions or comments, please feel free to leave them in the comments section below. Don't forget to like and subscribe to our channel if you enjoyed this video, and be sure to check out our other videos for more analysis and discussions on current events and issues. We'll see you in the next one.